Welcome to Mizuho Market Mindset for Q2. This is Jeb Slowick. I'm joined with Jackson Merchant, who heads up our leverage loan capital markets business, and Sam Orr, who runs our CLO business. I think we've all heard the stat that CLOs represent 60 to 70% of the term loan B market. At the same time, CLOs are dependent on new money TLB transactions that provide adequate equity returns to deploy their funds. So given that interdependence, and recognizing that both markets have seen meaningful rate compression as well as record volumes, I wanted to take a look at the overall market through both lenses, the CLO market as well as the leveraged loan market. So I'm going to start with you, Jackson. Why don't you walk us through some of the key things that you're seeing in the market?
Q2 was another strong quarter for the leveraged loan market, continuation of what we saw in Q1 of this year with a number of trends and themes that accelerated. Repricing volumes, for one, continued. Spread compression, borrowers are able to raise the money for a much cheaper cost than they were in 2023. And then a continued increase in risk-on appetite from investors, fueling a number of themes and takeaways in the marketplace. Touching firstly on repricing volumes, we had $380 billion in Q2, tracking to be a record year, where in general, borrowers are saving 25 to 50 basis points. In terms of spread compression, refinancing and opportunistic transactions are both benefiting from this trend. Borrowers are saving 50 to 100 basis points than what they would have at this point last year. Thirdly, the theme of the risk-on sentiment from both term loan B and bond investors that's driving a demand for money in the asset class. We've seen LBO spreads low 300s to mid 300s for marquee deals like AssetMark and Grant Thornton. We've seen that offset the fact that the Fed has not cut rates in 2024 by allowing leverage levels to get higher thanks to these lower spreads, despite this lack of a Fed cut. We've seen an uptick in demand for syndicated second lien with over $5 billion raised and issuers generally able to get the paper at only 200 basis points behind the first lien, which is a record level of lows. And then we've seen a pickup in dividend deals as well as portability, that is, having deals that can survive a change of control in our marketplace. So all themes of a very strong market and a backdrop that's been very conducive for borrowers.
And Sam, on your side, I feel like in 2023 and even coming into 2024, there was this huge fear in the term loan B market that CLOs had this maturity wall coming and the end of the reinvestment period, as well as access to cheap AAA capital. How do you see that playing out going forward?
Yeah, that's exactly right. I think at the end of 2023, coming into 2024, about 40% of the CLO market was exiting its reinvestment period. And typically when that happens in a CLO, it makes it much more difficult for them to buy new issue loans or have any sort of real, net positive demand. But what we've seen in the CLO market is not that dissimilar to what Jackson was describing the term loan market. Just robust issuance. We've had about $80 billion of new issue supply, about $70 billion of reset issuance. And that number has actually shrunk from 40% of CLOs being at the end of their reinvestment to about 30% today. So that's a very positive technical that we're seeing in the market today.
And I've read a lot about, and we focus on the banking side, the totality of the CLO issuance, and I think it's around $100 billion. But I've read about net supply being equally or maybe more important. Can you comment on that?
Despite the robust issuance, the net supply numbers are actually pretty marginal. At the AAA level, which really drives economics in the transaction and drives demand in the market, we're flat to 1 billion or so. It's tough to get the precise numbers. And then if you look through the rest of the capital structure, we're somewhere between 15 and 20 billion. So less than 20 billion in total net supply. And that's for a variety of reasons. All the resets and refinancings in the market's about 70 billion reset volume and 40 billion refinancings. That's not new paper. And then in addition to that, all the repricings that you're talking about in the term loan market, naturally amortizing the CLO structures. So that paper is going away. So the net supply number remains very manageable.
Got it. And Jackson, everything you mentioned seems incredibly robust and constructive. Why aren't we seeing more new money deals and LBO transactions today?
Yeah, it's a great question. I think many folks were forecasting that M&A volume and the related financing volume would pick up by this point in the year. Unfortunately, that has not manifested itself, and we still are slower on the LBO and the M&A side for new money. And what's filling the gap, as I mentioned a bit, is the dividend deal, the syndicated second lien deals. However, it's not enough to meet the demand, and that's why spreads keep going tighter.
So given that, how are you advising issuers and even investors for that matter when you think about a potential Fed move over the next couple of quarters as well as election risk?
As we see it now, it makes sense to take advantage of the market right now for two reasons. Firstly, as I mentioned, there's not a lot of new money supply, so you have the market to yourself, so to speak, and get the best pricing outcome. Also, with elections, we've looked, and over the last 3 election cycles, as you might imagine, volatility picks up. And this election cycle is probably going to be no different. So the closer we get to November, with volatility expected to pick up, it benefits borrowers to tap the markets this summer and in September before that potential volatility spikes.
And I think in most cases, this isn't a marginal volatility pickup. It's fairly meaningful from a new issue perspective.
Absolutely. When you look at both historically from a rate basis and a spread basis, material movements in a very short period of time during past election cycles in the U.S.
And Sam, another one for you. When you think about the equity arb, which over the years at times is very challenging, how is CLO access to equity today? And do you see that materially changing as you look into the rest of 24 and 2025?
I think by and large, the CLO market has done pretty well. And as we've seen spread compression in our market, the ARB has improved and we're seeing more interest from third-party CLO equity buyers. There's been a lot of money raised by CLO managers to help support their own deals in dedicated CLO equity funds. And I think that theme continues. Given all the volume, the resets and refinancing that has gone on this year, I think that those vintages of equity that has been optimized, so to speak, will continue to perform well and produce good returns. And I think, CLO's floating rate nature has really benefited from this higher rate environment recently. We're approaching, spreads that are inside of sort of long-term historical averages. And as a result, we're seeing more equity demand.
Great. So I guess the simple question for you is, when acquisition financing starts to really come back in scale on Jackson's side of the fence, are you going to have enough CLOs to buy that paper?
I think we will. I think the demand is here to stay. The net numbers are very manageable, and there's been a variety of channels of new money. So I think we'll be here to help support you guys.
Great. Well, look, on behalf of both our CLO team and Leverage Finance, we appreciate your time. And please reach out to us should you have any questions.